In 2020, Luckin Coffee admitted to fabricating roughly $300 million in sales. The stock collapsed. The company was delisted from Nasdaq. Executives were fired. And then something unusual happened. The company didn't disappear. Today, it operates over 29,000 locations and reports billions in real revenue. This is not a story about redemption. This is a story about how digital fraud works, how it hides, and why some companies survive what should have killed them. Luckin Coffee launched in China in 2017. The market was already occupied. Starbucks had been there for nearly 2 decades. Luckin entered with a different model. No large storefronts, no seating. Everything happened through an app. The customer ordered on their phone, pickup or delivery, nothing else. The pricing was aggressive. Almost every transaction was subsidized. Coupons, discounts, free drinks. The customer paid less than cost. Luckin covered the difference. The goal was not profit. The goal was market share. Stores appeared everywhere. Office lobbies, transit stations, residential complexes. By the end of 2019, Luckin operated over 4,500 locations. More stores than Starbucks had built in 20 years. The company went public on Nasdaq in May 2019. It raised over $600 million. The valuation climbed past $4 billion. Investors were buying growth. The data looked compelling, transaction volume rising, store count accelerating. But the pressure inside was extreme. Growth targets were obligations, not projections. When real demand couldn't match the numbers promised to Wall Street, the company faced a choice: admit the gap or close it artificially. Luckin chose the second option. The fraud began inside the data itself. Luckin's fraud did not involve fake stores or imaginary products. Coffee was brewed, orders were processed, customers existed. The deception occurred one layer above reality, inside the transaction systems used to measure demand. The objective was not to invent a business, but to exaggerate one. Management needed higher order volume, faster growth, and stronger metrics than real customers could provide. To close that gap, Luckin created artificial transactions that looked identical to genuine ones. Related party entities and controlled intermediaries were used to place large numbers of orders through Luckin's own app. These were not random test transactions. They followed normal customer behavior patterns. They occurred across real stores. They generated delivery requests, receipts, timestamps, and payment confirmations. On the surface, nothing was missing. The money, however, behaved differently. In a real sale, cash enters the company from the outside and remains there. In Luckin's system, funds circulated. Capital was advanced to partners. Those partners spent the money back into Luckin as orders, vouchers, or credits. Luckin recorded the inflow as revenue. The same money then flowed back out as marketing expenses, delivery fees, or vendor payments. The loop created activity without income. To maintain plausibility, costs were inflated alongside revenue. Higher sales were matched with higher expenses. The company appeared to be scaling aggressively while burning cash, a narrative investors accepted. Volume concealed the manipulation. Millions of real transactions created noise. Within that noise, synthetic orders blended in. Digital fraud does not require one large lie. It requires many small ones that agree with each other. Auditors saw systems producing consistent data. What they did not see was that the system itself had become the tool of fabrication.
Luckin's fraud persisted because it aligned with how modern audits are structured. Auditors do not inspect every transaction. They evaluate systems, controls, and statistical samples. Luckin's systems functioned as designed. Orders existed, payments cleared, expenses tracked revenue. There were no missing stores, no absent inventory, and no physical contradictions. The data agreed with itself. Context reinforced the illusion. Hypergrowth was expected, losses were tolerated. High costs were interpreted as investment, not warning. The business appeared to be doing exactly what fast-scaling tech-enabled companies were supposed to do. Digital platforms further complicate detection. When transactions are generated by software, the system automatically creates complete records. Each fake order produced a valid timestamp, receipt, and ledger entry. Auditors could confirm that transactions existed without confirming that demand was real. Sampling worked against detection. Synthetic orders were mixed into millions of legitimate ones. No single transaction looked abnormal. The fraud was statistical, not singular. Related party exposure was also difficult to isolate. Partner entities appeared independent on paper. Payments moved through multiple accounts. By the time discrepancies surfaced, they appeared as complexity rather than deception. This is the core weakness of digital auditing. Systems are trusted because they scale, and when the system itself is compromised, verification becomes circular. Auditors confirmed the outputs of a machine that was designed to fabricate credibility.
Luckin's fraud did not unravel from a single discovery. It collapsed under accumulation. By late 2019, external researchers and internal reviewers began noticing that reported revenue growth did not reconcile cleanly with cash balances and partner activity. Certain counterparties appeared repeatedly. Some payments moved in patterns inconsistent with consumer behavior. These were not proof on their own, but they were enough to trigger an internal investigation. That investigation bypassed surface metrics and examined transaction origins. What it found was decisive. Senior executives had authorized the fabrication of sales through coordinated partner transactions totaling roughly $300 million. In April 2020, Luckin disclosed the findings publicly. Trading was halted almost immediately. When shares reopened, the stock collapsed by more than 90%. Nasdaq moved to delist the company. Lawsuits followed from investors. Regulators in the United States imposed financial penalties and compliance bans. Chinese authorities also intervened. Executives were removed. Some were fined. Others were barred from leadership roles. Publicly, the case appeared finished. Another growth company had imploded. Another fraud had ended. But beneath the market reaction, the operating business continued to function. Stores remained open. Transactions continued. Coffee sales persisted. What failed was not demand, it was trust. And that separation between product and data would determine whether the company could continue at all. Most companies do not survive fraud of this scale. Once credibility collapses, access to capital disappears, partners withdraw, and operations unravel. Luckin avoided that outcome because the fraud was not embedded in the physical business. Customers were still buying coffee, stores were still generating cash at the register. After delisting, the company entered a controlled restructuring rather than liquidation. The priority was containment. Management associated with the fraud was removed. The board was reconstituted. Internal controls were redesigned under external supervision. Expansion stopped. The objective shifted from growth to verification. Subsidies were cut back. Promotions were narrowed. Store performance was evaluated individually. Locations that could not reach break-even were closed. Others were standardized to reduce cost variance. Supplier contracts were renegotiated. Inventory was simplified. The company reduced complexity everywhere it could. Most importantly, revenue recognition was rebuilt from the transaction level up. Every sale had to reconcile with cash. Partner exposure was reduced. Related party structures were eliminated. The business became smaller, slower, and measurable. This process was not fast. It was not public, and it was not guaranteed to work. But as false demand was removed, a real baseline emerged. The question was no longer how fast Luckin could grow, but whether what remained could sustain itself without distortion. Once fabricated demand was removed, Luckin had to confront its real economics.
The numbers were smaller, but they were real. Management shifted focus from headline metrics to unit performance. The question changed from how many stores could be opened to how many stores could make money. Pricing was recalibrated. Permanent subsidies were reduced and replaced with targeted offers tied to repeat behavior. Menus were simplified to increase throughput and reduce waste. Labor scheduling was tightened. Rent negotiations prioritized high-traffic pickup locations over flagship presence. The app, once used to inflate activity, was repurposed to optimize operations. Demand forecasting improved inventory control. Order batching reduced delivery costs. Loyalty programs were redesigned to reward frequency rather than volume. These changes compounded slowly. Margins stabilized. Cash flow improved. Expansion resumed only after stores demonstrated profitability. The company's growth narrative inverted. Instead of promising future scale, Luckin proved present discipline.
By the mid-2020s, the results were no longer theoretical. As of the third quarter of 2025, Luckin operated approximately 29,214 locations globally. Quarterly revenue reached 15.29 billion renminbi, more than $2 billion, generated by verified transactions and real customer demand. These numbers were not projections. They were reported after restructuring, after governance changes, and after the removal of fabricated activity. This mattered. It meant the company was no longer selling a growth story. It was operating a disciplined retail system at scale. Not many firms survive fraud of this magnitude. Fewer do so while becoming operationally stronger than before. Luckin's second expansion phase was deliberately unremarkable. There were no promises of disruption and no claims of exponential demand. Growth resumed only after systems proved stable and stores demonstrated repeat profitability. New locations followed a template refined through operational data. Small footprints, limited seating, high turnover, pick-up-first design. Each store was treated as a unit of production rather than a branding statement. Expansion clustered around dense urban zones to reduce logistics cost and improve delivery efficiency. The app remained central, but its role changed. It no longer existed to inflate engagement metrics. It coordinated inventory, staffing, and demand smoothing across locations. Scale emerged from repetition, not acceleration. This mattered to investors and regulators alike. The company was no longer valued on projected dominance, but on demonstrated cash generation. Financial reporting became boring by design. Growth curves flattened, then stabilized. Costs tracked revenue predictably. The business became legible. By the mid-2020s, Luckin operated tens of thousands of locations, using a model optimized for consistency rather than spectacle. This was not the growth story markets usually reward. It was slower, more constrained, and far more durable. The illusion had been removed. What remained was a standardized retail machine that could expand without lying about how it worked.
Luckin Coffee represents a specific moment in the evolution of corporate fraud. It was not about hiding losses or stealing cash directly. It was about manufacturing proof. The app was built to measure demand with precision. That same precision was turned inward. Transactions became evidence. Activity became validation. Growth metrics became the product sold to investors. This is digital activity fraud. The deception does not sit in warehouses or balance sheets. It sits inside the systems designed to provide visibility. That is why it scaled so quickly, and why it took so long to see. Earlier eras relied on different assumptions. In the 1970s, equity funding used computers to invent insurance policies that never existed. The system generated documents, and auditors trusted the machine. In the 1980s, Miniscribe did the opposite. It abandoned digital illusion entirely and relied on physical certainty. Boxes were shipped, inventory was counted.
weight was measured. No one opened the boxes. They were filled with bricks. That was physical inventory fraud. Two different methods, the same logic. Each fraud hides where trust is highest. In Luckin's era, trust sits in dashboards, apps, and engagement metrics. In Miniscribe's era, it sat in physical goods and shipping receipts. Technology does not eliminate fraud, it relocates it. Each generation learns how to hide inside the tools built to measure success. Luckin survived because the fraud lived above the product. Miniscribe collapsed because the fraud was the product. The next story moves backward in time, but not backward in logic. It explains why, sometimes, the simplest deception is the hardest to detect.